Hello and good morning, folks. Welcome back to Almus Market Mornings with Shikhar Garg. And we begin the week with a muted action yesterday as compared to the bumpy ride we had in the previous week. And it's all the more reasonable as of now. But quite interestingly, the whole banking sector fears have taken a breather for the time being as traders were observed edging cautiously towards a risk on sentiment. Even oil rose after the disruption to supply from Turkey and the easing of banking concerns. But what's more interesting is after the Fed and ECB both remained on their rate hike path, we have a slight change in commentary by the Bank of England Governor Bailey. He mentioned that the rates may probably stay below the high seen before the financial crisis, and these decisions won't be affected by the crisis hitting the global banking systems. They may come up with one or two another rate hikes, but all in all, his guidance towards rates being lower than the previous financial crisis is quite interesting to watch. So, JK, what are your thoughts on these fronts?
Hey, good morning. Yeah, it was another day of calm waters in the markets, and the news itself was positive right from Asian time. While the market was prepared for another weekend of negative news, what we got was the First Citizens, of NC buying out most of the assets from bankrupt Silicon Valley Bank, reportedly at a 16 billion discount to their current markets price. The Fed liquidity programs discount window borrowing also remained high, but about 110 billion for the week ended March 22. But the other data were suggesting that the liquidity facility programs were not needed. So that was another slight positive news. And then official statements and speeches continue to harp on US banking systems being sound and that authorities had taken appropriate quick action to protect the economy and strengthen public confidence in the banking system. After Lagarde on Sunday, Bank of England governor, as you said, was also expressing confidence that both the financial and the price stability could be handled effectively by appropriate authorities and also with the tools already available with them. So, in a sign that things were calming down, Treasury yields jumped 2-year up more than 25 BPs at 4.03, 10-year up 17 BPs at 3.54. A big auction of fresh 2-year notes issued by the Treasury received poor response, and that's not surprising where the yields are, considering where the yields are today. The stocks Dow and S&P were positive, while Nasdaq was negative. Quite obviously, the rising yield works against the tech sector. All the major bank shares, including the Deutsche Bank and the First Republic, were higher, with the closely watched KBX banking index also up by 0.6%. Shares of First Citizens were up by 50%. Now, while we are seeing relative benign environment after the turmoil of last weeks and several emergency measures by authorities, it's difficult to think that the core problem of low-yielding assets carried in the bank's books will vanish. For a more sustainable improvement in the sentiment, we need official rates to come down and economy to cool off substantially. But so far, at least, we haven't had any such signs. For instance, last week's jobless claims still came at a very low, like 91,000. That confirmed that the job sector is still strong, and so the demand will remain strong. If Fed does not pause, let alone cutting going forward, the issues are bound to resurface at some point through weaker institutions. So we are also looking at the impact of the most aggressive monetary policy tightening in decades across many other countries, particularly in Europe, where the rates have moved from deeply negative territory to as high as 3.5%, and more is coming. In fact, S&P Global has warned that what's happening in global banking system is going to tighten credit conditions, particularly in Europe. So other problem that's likely to persist is depositors' realization that banks are paying them zilch as interest, even as official rates are far higher and money market funds are giving much higher. This can see more outflow of money from the banks. The banking crisis that broke out earlier this month spurred some swift shifts in where people park their cash. The money market assets in US sold past 5 trillion, with as much as 425 billion being added in the week ending March 22, as individuals and institutions understandably fretted about the potential downside from leaving too much in bank deposits, that too at a very negligible interest. So the Fed's interest rate hikes have already helped push the total park in such funds beyond the pandemic era. record. So that's a big change that's happening, but banks will have to put up with less liquidity and access more and more facilities which is provided by the Fed. So key to all this would be whether the economy really sees tightening conditions and whether that results in a cooling off of inflation. And without that, if the Fed is still to embark on more rate hikes, I think these problems have not gone away at all. Now, the benign risk sentiment was nowhere better reflected on USD, which rallied more than 1.5% from its low of 129.63. But it was a mixed performance from other pairs. EM currencies, including those of Asia, were relatively weaker, while majors like Euro and GBP made more progress. GBP is good data, and possibly another rate hike based on recent inflation data has encouraged more bullish stance. Also reflecting better mood was the IFO data from Germany that came better for 6th month in a row, and that's been huge improvement in the sentiment in the last 6 months. Now, also reflecting better mood was the rise in oil prices, as you said. Brent rising to 78, which is a 10% rally from the recent low of 70.12. Now, from a broader perspective on the dollar, one cannot be faulted to think that the greenbacks bear trend is getting really well entrenched now. Two things, look at it. We had yields rising quite a bit in the last few sessions. The 2-year rose nearly by 70 BPs, and the dollar has not gained except against the yen. Also, this is the first economic financial crisis that has not resulted in enhanced demand for dollar as a safe haven. So this is definitely a slow erosion of safe haven appeal of the dollar. So we'll watch how this pans out in the coming days, even if Fed hikes rate once again. On the rupee, not much to write home about. It was really a very tight 10 paisa range, but we are seeing some reaction to the fresh weakness of the dollar index to the downside on the dollar rupee, trading now below 82.25. But as has been the case recently, the dips are very eagerly bought into by oil companies and other importers. Key to this would be whether we have those last days flows of financial year, and which can dent the dollar's rate, particularly if there are not enough bids. That's really something that we'll have to wait and watch. Thank you.
Okay, JK, that was quite good. And yes, folks, the one statement which JK mentioned hits quite really well and makes us think. The erosion of safe haven appeal of dollar. I mean, the world has been showing signs of this, and it's quite interesting to watch. But what's more interesting is the business sentiments in Germany changing. For the 6 months in a row, they are in the positive side, which is quite good. And yes, on the other side, we do have concerns on the global growth. As the World Bank has mentioned, the impact of the most aggressive monetary tightening policies by the central banks across is now visible. All said and done, folks, we have a very exciting and an interesting thing coming up. We have Mr. Arvind Chari, the Chief Investment Officer of Quantum Advisors, joining us today, along with Mr. Maulik Shah, to share some insights on the current market situation, whether the central banks are looking for price stability or they are looking for financial stability, and what should be the way ahead. So folks, it's going to be a cracking session, and I've always loved listening to Mr. Arvind Chari. He has some very interesting and raw insights in store for you. So I hope you guys join us today at 5 p.m. We will be sharing updates soon on the same. Thank you so much for joining.